Oh my god, it's skyrocketing! A bull market! I'm getting rich! This kind of market is a once-in-a-lifetime opportunity and I managed to catch it! Investors who were celebrating the market surge with tears of joy the day before could never have predicted that next day they would face a market crash that completely changed the tone. Who could have imagined this? Yesterday it was a bull market. I made 90,000 yuan, but today I lost 140,000 yuan, including both principal and profit. All the stocks I held hit their daily limit down. My small account with 6 stocks, all of them hit the limit down today. I'm shaking from the losses. If I had known this would happen today, I would never have bought it at the end of the day yesterday. I would have sold everything last night and stayed away. I imagined 1,000 different outcomes, but I never thought it would drop 5,000 points and that over 4,000 stocks would fall more than 10%. I never expected that all my stocks would hit the limit down and I wouldn't be able to sell. I'm clearing my positions tomorrow. I'm done with this.
This is my second day trading stocks. It's now 3 p.m. on October 9th and the market has closed. I've lost 56,000 yuan. I believed what Dalan said, so I went all in on stocks, and now I've ended up with this. The problem is, even if I want to sell now, I can't. I even tried to buy the dip today with another 100,000 yuan, but the more it dropped. And weren't they supposed to revitalize the market? Where's the intervention? And what happened to the Shanghai Composite Index? It was over 3,400 when I last checked, and now it's down to 3,258. I have no idea what to do anymore. Can someone show me a way out?
Today is the worst day in my entire investment history. My personal account lost 35,000 yuan, and the 300,000 yuan I invested in ETFs lost 47,000. Combined, I've lost over 80,000 yuan. Oh my god. On Chinese video platforms, it's easy to find stories of investors losing hundreds of thousands.
Today, I looked and saw I've lost 1.2 million yuan. I'm numb from the losses. This market is so unfriendly to new investors. Out of 5,000 stocks, more than 4,000 dropped, with losses of over 5%. I thought there might be a correction on the 10th or 11th, so my plan was to cash out with a profit on the 8th or 9th after making 1,000 yuan, but I didn't expect the correction to come early and hit this hard.
Many Chinese investors, once cheering for the booming stock market and hopeful for China's bright economic future, have now seen their optimism shattered. They went from this to this.
With this wave, out with the old and in with the new. New investors are now becoming old ones. Those who were finally freed from losses yesterday are now stuck again today, losing 1.87 million yuan. I have 2 pieces of news. The good news is I made over 10,000 yuan on my semiconductor stocks. The bad news is my other stocks have tanked such a familiar feeling.
This latest stock market surge was triggered by a series of monetary policies rolled out by the Chinese Communist Party, CCP, offering a glimmer of hope to investors in the market economy. Around September 26, the Chinese government introduced a 3-pronged strategy to stimulate the economy. This included the central bank's announcements of reserve requirement cuts, interest rate reductions, and lowering rates on existing mortgages. The government also provided loans to investors and companies repurchasing stocks, creating the impression that it was fully committed to boosting the economy. Additionally, the CCP's Politburo meeting promised unspecified fiscal measures. During the meeting, the CCP acknowledged that China's economy faces many new challenges. The meeting also emphasized the need to curb the ongoing downturn in real estate market and achieve the goal of stopping the decline and stabilizing. This gave many hope that the properties they were holding onto might still recover in value. On the same day, Reuters published an exclusive report citing sources that said the Ministry of Finance plans to issue 2 trillion yuan, approximately $285.7 billion in special sovereign bonds. Of this, 1 trillion yuan will be used to subsidize the renewal of consumer goods and large commercial equipment, as well as provide families with 2 or more children a monthly allowance of 800 yuan, approximately $114 per child. As these policies were rolled out, China signaled upcoming market benefits. On the evening of September 26, CITIC Securities stated that Beijing's comprehensive policies were sending positive signals, suggesting that more targeted and effective growth measures could be expected. Fueled by these policies and sentiments, China's stock market saw an unusual rebound despite the bleak economic backdrop, with many Chinese citizens seemingly brainwashed into believing this recovery. Foreign institutions also appear optimistic about the stock market's rise. Goldman Sachs mentioned in a report that hedge funds were racing to buy Chinese stocks, with September 24th seeing the largest single-day net purchase since March 2021, and the second highest level in nearly a decade. Meanwhile, Bank of America strategist Winnie Wu pointed out that this was the first time the Chinese government encouraged leveraging investments in the stock market, and under the influence of leverage, there could still be significant room for growth. Veteran investors, along with new ones looking to make money, were all in with their savings, chanting that China's economy is on the rise, that China has defeated the United States because while the US lowered interest rates, China's stock market has entered a bull market. In the video, a 91-year-old investor who appeared to have fully bought into the narrative said, "What does this stock market boom mean? It signals that our country will become the world's #1 power. If thousands of stocks hit their limit up, it's like the government is indirectly giving money to the people, stimulating consumption and driving our domestic economy. From now on, our country won't rely as much on exports and foreign trade. Meanwhile, the US will face more severe manufacturing decline, and our nation will only grow stronger." As praise for the market was still echoing, the stock market began to plummet on the second day of trading after the holiday. At this point, the Chinese authorities shifted their tone, and the promised substantial monetary policies turned out to be empty words. On October the 8th, following a drop in the stocks of the Chinese companies listed in the US, the National Development and Reform Commission, NDRC, held a press conference. At the event, NDRC Director Zheng Shanjie set China's annual economic growth target at around 5%. However, he also admitted that the economy is facing difficulties and the global environment is becoming increasingly complex and extreme. The purpose of this meeting was to defend the authorities' recent implementation of a series of incremental policies, including monetary measures. Additionally, NDRC Deputy Director Zhao Chengxing unexpectedly became the focus of the meeting when a Reuters reporter asked whether there was an estimated scale for this policy package and whether the 5% economic growth target for the year could be achieved, as well as if the current deflationary pressures would ease. Zhao's response was vague, simply stating, "Director Zheng has already mentioned many key points," and "Director Zheng has thoroughly explained these matters. As long as you focus on the core points he mentioned, it will help you understand the incremental policy package. I believe Director Zheng's message is very clear." Apart from repeatedly referencing Director Zheng, Zhao's answers lacked substance. Some Chinese netizens mocked Zhao's responses, saying that everyone should learn to speak like Zhao, delivering seemingly logical and confident statements that in reality say nothing. This communication skill is deemed highly practical in Chinese officialdom. However, the public had hoped for further measures to stimulate the economy after the press conference, but now it was clear that no new policies or initiatives were introduced, leaving everyone disappointed. Some netizens believe that this is far from a full-fledged effort by the CCP to save the economy, and the current state of the stock market reflects the inadequacy of previous fiscal policies. Investors who trusted the CCP's promises are now left to bear the losses themselves. In previous programs, it was mentioned that this abnormal bull market was orchestrated by the CCP for two purposes. First, to target the 147 trillion yuan in savings held by the public, enticing these funds into real estate and stock markets to extend the regime's survival. Second, to fulfill promises made to companies and capital interests, helping them cash out and exit the market. Evidence suggests that these speculations were correct. In addition to the previous reports about 146 A-share companies reducing their holdings, major funds also began exiting the market. On October the 8th, while A-shares surged in the afternoon, both the Shanghai and Shenzhen markets saw a significant outflow of main funds, with a net outflow of 169.8 billion yuan throughout the day. According to data reported by China's Securities Times, on October the 8th, 404 stocks saw main funds outflowing more than 1 billion yuan each. The top three were East Money, Wuliangye, and Chang'an Automobile, each seeing outflows exceeding 2 billion yuan. Additionally, stocks such as Vanke A, China Yanqi Power, and Guizhou Maotai and Hikvision also saw net outflows of over 1 billion yuan each. Among popular industries, leading liquor brands faced heavy sell-offs by major funds, with amounts reaching 2 billion yuan for Wuliangye, 1.4 billion yuan for Guizhou Maotai, and 892 million yuan for Luzhou Laojiao. In the passenger car sector, Chang'an Automobile saw outflows of over 2 billion yuan. Seres experienced 1.1 billion yuan and BYD had outflows of 862 million yuan. Additionally, power companies such as China Yanqi Power and China National Nuclear Power were also hit with large fund outflows. These industries, previously promoted by the CCP, are now the main targets of stock sell-offs, which speaks volumes. Wind data showed that on October the 8th, the main funds across the Shanghai and Shenzhen markets saw a net outflow of 170 billion yuan for the entire day. Among them, Chinex board experienced a net outflow of 45 billion yuan, and the CSI 300 saw a net outflow of 56 billion yuan. Political and economic commentator Wu Jialong believes that the CCP's market push was aimed at allowing major shareholders and corporate leaders to cash out. The surge in the stock market was purely to facilitate selling. As the saying goes in the stock market, the rise is always for the purpose of selling. Wu added, why wouldn't they cash out during such a favorable market, especially since they have no confidence that the economy will improve in the future? Chen Songyu from the Institute of National Development and Mainland China Studies at Chinese Cultural University in Taiwan explained that companies' desire to sell their shares indicates that business owners and shareholders are not optimistic about the future. If they are also under pressure from loans, it is understandable why they would sell their holdings to convert them into cash. Fan Jiazhong, a professor of economics at National Taiwan University, also pointed out that everyone knows this is a wave of escape and that the gains won't last. He compared the situation to a zombie market briefly jointing to life, prompting investors to quickly sell. With mainland Chinese stocks rising by 25% and Hong Kong stocks by 35%, investors are seizing the opportunity to clear out their holdings, anticipating a rapid downturn in the stock market. While China's stock market was still booming, economists at Nomura Securities warned investors to soberly assess risks and prepare for a significant downturn following the rebound. On October the 3rd, economists led by Ting Lu wrote in a client note that, in the worst-case scenario, the stock market frenzy could be followed by a crash, similar to what happened in 2015. They cautioned that a bubble is forming in the Chinese stock market, with the likelihood of a pessimistic outcome being much higher than an optimistic one. Over the coming weeks, the risk of a sharp rise and fall, reminiscent of 2015, will increase due to the ongoing real estate crisis, heavy local government debt, escalating geopolitical tensions, and the bursting of the new energy investment bubble. Combined with a sharp decline in trust between public and private sectors, all these factors contribute to economic fragility. If the rebound turns into a slump, the situation could worsen, leading to capital flight and significant depreciation pressure on the yuan. Nomura Securities further warned investors that after the initial euphoria, they should prepare for the worst possible outcome. Neo Won, Managing Director of China Research at Evercore ISI in New York, believes that if a stock market crash similar to 2015 occurs, it will be an unbearable burden for China's leadership. The recent sharp declines in the stock market seem to align closely with predictions made by economists at Nomura Securities. Li Hui, an investment advisor at Western Securities, observed that during the National Day holiday, a steady stream of investors came to open accounts and seek investment advice. Having worked in the securities industry for over 14 years, witnessing the 2014 bull market, Li feels that this current rally is much more intense, and just as the surge is stronger, the decline could even be more severe than in 2015. However, Nomura's base case is that the scale of this bubble burst may be smaller because Beijing is likely to introduce fiscal measures to stabilize demand and maintain basic local policies. But these measures might not solve serious structural issues, nor will they be able to clean up the real estate sector's mess. On October the 8th, after a sharp rise at the market open, the 8 shares quickly retreated, prompting many investors to quietly exit the market. An investor born in the 1980s shared that he took advantage of the early rise in the morning to sell a stock that had been stuck at a loss. He still holds 2 other stocks at a loss and is waiting for the market to recover further to break even. Another seasoned professional trader revealed that he also reduced his holdings on the morning of the 8th, believing the market had risen too much in the short term and was likely to correct soon. An investor admittedly to withdrawing family savings before the National Day holiday to invest in stocks. After purchasing the rally on the 8th, the market dropped, leading to a loss of nearly 30,000 yuan. For many investors who have incurred losses, the future direction of China's stock market has become a key focus. Morgan Stanley, a well-known international investment firm, has stated that if the Chinese government announces more spending measures in the upcoming weeks, the Chinese stock market could rise another 10% to 15%. A private equity fund manager known as LD Xiaomao expressed a more pessimistic view, interpreting Morgan Stanley's assessment as a bearish signal. He explained that Morgan Stanley's statement has 3 implications. The first is that if China does not announce more fiscal measures soon, the stock market has already peaked in the short term. The recent rally since September 24th has been driven purely by monetary policies, meaning without further fiscal stimulus, this rally may have reached its limit. The second implication is that if Chinese government introduces fiscal policies, the stock market could continue to rise. The scale of the rise will depend on the strength of the policies, with a potential increase of up to 15% if measures are substantial, or a more limited rise if the policies are weaker. The third implication is that regardless of the strength of fiscal policies, the maximum potential increase for the Chinese stock market in the near future is 15%. LD Xiaomao believes Morgan Stanley's overall outlook is quite pessimistic, essentially signaling that it's time to sell rather than buy. After all, if the market's growth potential is capped at 15%, isn't that an extremely cautious outlook? He emphasized, people shouldn't dismiss Morgan Stanley's assessment. Only those who have experienced multiple bear markets in A shares will take it seriously. Back in August of last year, Morgan Stanley warned that the A-shares market had peaked and advised investors to take profits. Sure enough, the market fell from 3,200 points to 2,600 points afterwards. Many regret not heeding their advice earlier. Now Morgan Stanley is once again predicting the trajectory of China's stock market, and their judgment has merit. It's clear that this surge in the Chinese stock market, whether A-shares or Hong Kong stocks, has been driven by sentiment and opportunism rather than real economic improvements. Can anyone say that China's economy has significantly improved? Has corporate profitability increased? Has the real estate market truly stabilized? The answer is no. Given that the economic fundamentals have not changed, this recent rise, driven by policy expectations, seems to have already reached its peak. It can be said that the future potential for future gains has been exhausted. Therefore, investors should remain cautious about the recent surge in China's stock market. Genuine bull markets take time to build, they don't happen overnight. Based on the current situation, Morgan Stanley's prediction for the market appears likely to come true, and the trajectory of China's stock market seems set. After a policy meeting with no substantial measures, the possibility of another significant rally seems increasingly unlikely.